Is your money in the bank safe? Well, the answer actually depends, and it also depends on what you mean by safe. Do you mean safe from a stock market crash? Do you mean safe from the bank itself failing? Or do you mean safe from being protected against inflation eating away its purchasing power? All three of these can have very different answers. And as we'll see throughout the course of this video, banks are at massive risk of failure due to massive losses on their balance sheets. With interest rates on bonds increasing to multi-decade highs with no signs of slowing down anytime soon, banks may be in massive trouble right now, which means your deposits may be in trouble as well. If you don't know who I am, my name is Joe Brown. I run Heresy Financial University, where active investors learn how to increase their returns while reducing their risk. It is the easiest and fastest way to learn how to start making more money investing. Link is in the description below. So why are banks at risk right now, and what can you do about it? Well, back in the day when you deposited your money with the bank, you deposited real physical gold with a company that you paid to hold it securely for you. They would give you a piece of paper that said how much gold you had deposited with them, and that paper gave you the ability to go get your gold at any time. Over the years, this practice morphed and changed with the introduction of fractional reserve banking, and then scaling that practice up to the national level with central banks, and then ultimately abandoning the gold standard altogether in 1971, which means that today in a pure fiat system, we still have the fractional reserve banking, but when you put your money in the bank, you're not paying them to store it securely for you. They're actually paying you to hold on to it for you. Now, they may only be paying you a measly 0.01%, but they're paying you nonetheless. Now, it's important to note that anytime there's a marketplace, if you're not paying for something, then you're not the customer. Most of the times you're the product. And in the case of banks, you are the lender. When you deposit money in a bank, you are actually legally lending dollars to the bank. They owe you that money back. You are a creditor. This highlights the first thing that's important about today's video, which is that savers are lenders. In today's fiat world, it's not possible to be a saver without simultaneously being a lender. And many times these dollars that you are saving are not only lent to the institution, but they're re-lent out over and over and over again in a process called rehypothecation, which basically just means your dollars move from one entity to another, to another, to another. And though it says those dollars are available in your checking account, if you and everybody else at the bank try and go get it, it's not there. So let's say you and all the customers of the bank do try and go get your money. Well, it's not there. In this case, the bank owes you the money. They don't just have your cash ready and waiting for you in a vault somewhere. So when that process starts, the first thing that happens is the FDIC steps in. The FDIC covers $250,000 per depositor per bank. This means if the bank fails because you and everybody else try and go get your money out of the bank, the FDIC guarantees that you will get up to $250,000 back. But there's just one big problem with this. FDIC is broke. The Deposit Insurance Fund at the FDIC has a balance of $116 billion. This means the Deposit Insurance Fund reserve ratio is only 1.11%. To put that into plain English, the FDIC guarantees that if you have a bank account at a bank that fails, that your deposits are guaranteed up to $250,000. The only problem is they only have 1.11% of all the insured deposits in the Deposit Insurance Fund. But let's just give them the benefit of the doubt, and let's assume that not all banks are going to fail at once, which is their operating assumption, which is why they only have 1.11%. So what happens if one bank fails? Well, if you have less than $250,000, you get all your money back. And for all the evil, greedy capitalists who have more than $250,000 in the bank, they get the honor of having the rest of their money confiscated through a bail-in, which converts debt into equity. And you think, whoa, this is a deposit. This isn't debt. Savers are lenders, remember? When you put your money in the bank account, you are a creditor. That bank owes you that money. It's debt to them. It's their liability. So any dollar over the $250,000 guaranteed limit converts from a loan to equity, meaning you no longer are owed that money. You are now a shareholder. Now, you might think this is great because now you're an owner of the bank, right? Well, this is something that most most retail investors aren't aware of, but in the investing world, it's better to be a creditor than it is to be an owner. Imagine you run a small business with you and your partner, and you take on debt to run the business. The business fails, you have to liquidate all the assets of the business. The first thing you have to do is use that cash to pay back that debt before you can distribute anything left over to yourself as an owner. And it's the same thing with companies. Creditors are first in line, then owners, which means that the bail-ins are not good for depositors. It essentially just means that anybody over that $250,000 limit is out of luck. Now, today in the United States, every bank is at risk of failure. And the reason why is because of what they do with your money. They have to do something to make money with your money. And what they do is they buy assets, which is typically just other debt. So they owe you money, but somebody else owes them money. And typically the interest rate on those is a little bit different and they keep the difference. Typically banks loan to the US government, which means that banks are holding on to a portfolio with massive losses right now. And the higher interest rates go, the worse these bond losses become. Right now, many treasury bonds are trading at 50 cents on the dollar. In the world of bonds, 50 cents on the dollar means that investors believe there's a chance that the borrower could default. We can get a very clear picture of what the balance sheet of banks look like by looking at the ETF TLT. TLT is an ETF that has 20-year or longer United States treasuries in it, which means that this chart that shows the share price of TLT looks very similar to the balance sheet of banks. Because TLT invests exclusively in US treasuries that are 20 years or longer in duration, they were loading up on long-term US government debt in 2020 and 2021 when rates were near zero. And as interest rates have skyrocketed since then, the prices of those bonds have utterly collapsed, which means that the share price of TLT is down 50% from its 2020 high. If anybody has ever told you that bonds were a safe haven asset, this proves that anybody who's ever told you that US government bonds are a safe haven asset did not know what they were talking about. Banks' balance sheets look very similar to this because they did the exact same thing, buying US government treasuries when rates were at rock bottom near zero in 2020 and 2021. And now that rates have started to skyrocket, their balance sheets are sitting on heavy losses. Meanwhile, hundreds of small banks are currently sitting on piles of commercial real estate loans that are underwater, collateralized by office buildings that are worth way less than what is owed on them. And now those piles of commercial real estate loans are much larger and higher concentrated than the FDIC guidance allows for. Banks bought these treasuries because they believed the Federal Reserve when Powell said, we're not even thinking about raising interest rates. We will not be doing so for a very long time. But as we all know, inflation started to rear its ugly head. It stuck around longer than they thought, and the Fed embarked on one of the most aggressive and quickest rate hiking and tightening monetary policy paths in recent history, leaving banks' balance sheets in shambles. Which means that any cash that you are saving right now is sitting in the hands of a middleman who has lost half of it. Which begs the question, if savers are lenders, why not just skip the middleman? Go straight to the source, or at least choose a better middleman. The point of saving is so that you have dry powder when you need it. And if there's the risk that the moment you try and go to get it is the very thing that makes it unavailable, in the case of a bank run, it's not exactly fulfilling the purpose of savings. There are three things that you need to be looking for with your savings. Number one, liquidity. It's there to access when you need it. Number two, you're getting a real return. When you look at the inflation rate, the interest rate you're getting paid should be higher than the inflation rate. That way you're not losing purchasing power. And then number three, you need to be looking at the risk. How many layers of risk are there? In the case of a bank, the bank could fail and any of the assets that they have could fail. So you want to be eliminating the counterparty risk and reducing the risk associated with whoever ends up with your money in the final stage. Regarding the real return, if you're trying to make sure that you are beating inflation with the yield that you're getting paid, you need to look at a few different measures because There is no one way to measure inflation. Everybody's inflation rate is going to vary. Trueflation is a third-party independent inflation gauge that sometimes reads higher than the CPI and at other times reads lower than the CPI. Obviously, you could use the CPI itself, but many people view this as the most flawed measure of inflation. There's also shadowstats.com, which shows a 1990-based inflation reading, which is currently a little under 8%, and a 1980-based inflation reading, which is currently around 12%. If we take the median of the widest range going from 2% up to 12%, then that would indicate that we're sitting somewhere around 6% right now. A great option to take advantage of interest rates right now would be with T-bills, which are extremely short term, maturing every 4 weeks to every 52 weeks. Right now you can get T-bills paying over 5.5%. Another great option is money market funds like this one at Vanguard paying over 5%. Now, believe it or not, this entire video is just one very small part of just one of the courses available on Heresy Financial University. Members of Heresy Financial University get unlimited access to every single course available, which includes things like options mastery, portfolio allocation, analyzing stocks, navigating the retirement account system so that you have more when you retire. And everything in this video comes from the brand new course, Cash Management Playbook. If you're not a member yet, you're simply missing out on making more money investing and not losing so much money on bad trades. You can start using the strategies of the pros today by signing up for Heresy Financial University, links below. Now, if you and I are being honest with ourselves, we know that they're not gonna let the biggest banks fail. But one thing most people don't realize is that small banks fail all the time and they do nothing about it. Take a look at this chart of bank failures from the FDIC, which shows not only the number of banks that fail each year, but also the total assets that are lost in those bank failures. We see every year there are a few bank failures, and interesting, in 2005 and 2006, there were 0 bank failures, which preceded the massive spike in bank failures for the Great Financial Crisis. The reason why that's interesting is because if you look at 2021 and 2022, those were also the only other years in which there were 0 bank failures, which preceded an even bigger spike in bank failures in 2023, measured by assets lost. And if this financial crisis cycle was any indication of how it's going to play out this time, given the pattern repeating itself so far, then we have many more bank failures to come. Also considering the fact that we have banks that fail every single year, and it never makes the news. Means that they don't consider every bank systemically important. They only bail out the big ones. It also demonstrates the entire financial system is on what I like to call the regulatory roller coaster to tyranny. Essentially, the whole system consistently flip-flops back and forth between bailouts and increased regulation. They come in to stop the failure and then they regulate it more heavily to stop the moral hazard. Eventually, you get to an environment where there is no free action taking place anymore. It's simply 100% top-down control. You get either a de facto or an outright nationalization of the banking system. And this time around, it will likely happen through a CBDC. Just ask yourself the question, how easy would it be to flip on the switch to consolidate the 6 internal ledgers at the 6 largest remaining banks, combining them into one central ledger at the central bank. This would eliminate pretty much everything what I've talked about in this video, that savers are lenders. Instead of the bank owing you money, your dollars are just an entry on a ledger at the central bank. It's no longer a liability. It's no longer debt. And this is still going on today. Jamie Dimon at the beginning of September recently blasted the regulators' new capital plans, saying he would love to know what they really want to accomplish, saying it is a huge negative over time to have to hold more capital. He even blamed central banks for the position of these massive losses they're holding right now, saying that central banks were the ones that told the world that rates were never going to go up. So he said, if I were them, I'd like to have a little bit more humility over stuff like this. He has warned that proposals like this are hugely disappointing and will make certain activities like mortgages and small business lending much harder for banks. And he is absolutely spot on about all of that. Now, you can say that he is biased and self-interested here, and absolutely he is, but it doesn't make what he's saying any less true. It is becoming more and more difficult for banks to be profitable in this increasingly heavy regulatory burden environment, where central banks and regulators are coming in to stop things that they caused in the first place. And that's not going to slow down anytime soon. In fact, if you follow this pattern through, we eventually end with a nationalized banking system, probably with a central bank digital currency. one unified ledger at the central bank. So this is probably where we are headed. But in the meantime, thankfully, you can do things to number one, beat inflation, and number two, reduce your risk. But in the meantime, thankfully, there are still a few things you can do to reduce your risk of bank failures and beat inflation just by doing a couple simple things. Number one, don't leave any more in the bank than you can afford to lose. Number two, use superior savings vehicles that give you a real return. When you adjust for inflation, you're still increasing your purchasing power, or at least not losing purchasing power. There are plenty of vehicles that do this for you, things like money market funds. Number three, reduce your counterparty risk and go direct to the source. If you want to invest in treasuries, don't do that through a bank, because that's where your money is ending up most of the time. Just go direct. Get T-bills from the source. And you can get the best bang for your buck by laddering them. So you constantly have some maturing, and when you roll it over, then you get that optimum bang for your buck with the longer interest rates. And of course, number four, sign up for Heresy Financial University for an extreme deep dive on how to do all this in detail and training on much, much more. So you can start making more money investing today. As always, thanks so much for watching. Have a great day.